Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken, and our model portfolio is up 7.76% year to date. And our goal here at SPY Trader Now is to beat the returns of the S&P 500 buy and hold investor, but their portfolio is outperforming ours so far this year. They are up 18.09%. There have been very little pullbacks in the S&P 500. I'll show you that in the charts later on in the presentation. Here are some past returns for SPY Trader Now in 2022. We had a great return of 21% compared to the S&P 500, down 19%. 2021 up 78%. 2020 we actually doubled the portfolio. If you want to see how I do this, go ahead and hit that subscribe button, ring that bell to be notified, and smash that like button down for me to help me promote this video. Last week, the S&P 500 gained 0.65% for the week. We did make a trade last week, and the trade went out on Friday, July 21st at 12:42 p.m. Pacific Standard Time. And what we did was we ended up closing out the long call. We had 3 contracts on 3 long calls. We closed them out for a nice profit. And we also rolled out our in the money call because my expectation is that the market is going to have a pullback eventually in the next 1 to 3 months. And I want to take advantage of that pullback by having that in the money call. So that way, when the market pulls back, and right now this call is worth about $36.62 per share. We have 2 contracts or 200 shares. And when the market corrects a certain percentage, that 36 will drop and go down in value. We'll buy it to close it for less than we sold it for, so we'll have a profit. And then when the market comes back up, because I believe we're in a strong overall bull market right now, then we'll take advantage of those gains. This is what it looks like when we sold out our long call position. We sold it out at 1507, and this is what it looks like on the TD Ameritrade platform when you roll out the calls that I just talked about. It tells you right here how you're going to open a position and close a position simultaneously when you roll out a position on this platform. Here are some of the trades that I have made in 2023. If you want to go back and see all my trades for the last 3 years, head over to SPY Trader Now. There'll be a link down in the description below for everything that I'm presenting to you today. So if you want to explore any of the web pages that I'm showing you, you can see the links, the hyperlinks directly in the description below. I have 2 open positions, and that's why those are in yellow. And this is the current trading price of what they're currently at. On our long call position, in which we sold out at 1507, we made a nice $537 profit, about 13% up on that position. So that was a nice healthy position for us. Here is our equity curve for the model portfolio year to date 2023. So this is how we currently stand. And here is the equity curve for the S&P 500 buy and hold investor. Really strong bull run for them. And here is the 2 equity curves combined, because here at SPY Trader Now, we always compare ourselves against the benchmark S&P 500 buy and hold investor in pink and our model portfolio in blue. Our goal is to surpass this portfolio. So we've got some work cut out for us, and we are going to work on this to make that happen. And here is the Fed Chair Jerome Powell. Last interest rate hike was May 3rd, 2023, 25 basis points. Fed fund rate 5 to 5.25%. And the next Fed announcement is going to be on July 26th rather. Well, guess what? That is exactly next week. That is in a few days. There is a high probability that we will have a 25 basis point rate hike on that announcement on the 26th. And this is going to potentially shake up the market a little bit. We'll see how this news reacts, but this definitely has an impact on the market. Now we're looking at things from the presidential election cycle theory, which states depending upon what year of the election you're in, we have historical rates of returns. Currently, President Biden is in the 3rd year of his term, and historically that has averaged 16.3% for a return in the third year of the presidential election cycle. Currently, the buy and hold investor is up 18.09%. So they are exceeding the historical average. So we're definitely a little top heavy from this perspective. Now we're looking at things from the bond market, which is 4 times the size of the stock market, and usually they are smarter investors than the stock market. The bond market currently has an inverted yield curve. We've had this for quite some time, and that means that the shorter term treasury rates are yielding a higher rate of return than the longer term 2 and 10-year yields. This is inverted, and this is not natural. This is going to correct eventually, and we're waiting for that to happen, but it has not happened yet. Every time it has happened, we've had an inverted yield curve in the past, and economic recession has followed. We have not had an economic recession yet. The Fed chair has done actually an excellent job balancing out and giving us so far a soft to no landing. The labor market is tight, and that is where we stand on the economic front. So we're keeping an eye on this. Also, we have rising interest rates. Both of these things are negative for equity, long-term equity investors. Now we're looking at things from a valuation standpoint according to current market valuation, CMV. Here's the link. It'll be in the description below. We're overvalued. We are overvalued by 52.9% on a PE ratio above the market average. The 10-year PE ratio was at 30. So we are just overvalued according to this. And on a standard deviation chart, we're overvalued by 1.3 standard deviations. So you got to understand that we have an elevated risk. It's difficult to base your investment decisions off of this because you can be overvalued for quite some time. Now we're looking at the Fear and Greed Index from CNN Business. This is our friend Warren Buffett, the sage of Wall Street. We are in extreme greed at 82. We're higher than last week. And we need to be cautious when we are in this extreme greed area. Now we're looking at things from a seasonality standpoint. Going back for the last 20 years, the S&P 500 in the month of July, our current month, 70% of the time we've closed higher than when we opened. We've already accomplished that goal. For the month, we are up 2.01%. So we've already accomplished that goal. There's about 1 week left of trading in this month. So we could even correct down just below 2% and still accomplish this goal. But that's where we currently stand on a seasonality outlook. Now we're looking at things from a long term. This is going back 20 years. This is a monthly chart, S&P 500 long-term bull run from 2009 all the way to 2022. Then we had a downward correction, broke out above it, never looked back. This particular angle of ascent is unsustainable. We are going to eventually come down a certain degree. It's unknown exactly how much we're going to come down, but this angle is an unsustainable angle. But one extremely positive thing here on this chart is how you have now a positive MACD crossover. Slow stochastics is already positive and reached 80. From a long-term perspective, we are in a bull market, a long-term bull market. Now we're looking at weekly chart, 5-year S&P 500, and at this point in time, we are up against a resistance level, this high right here. This is the all-time high, the previous all-time high. We still have to beat that. We have not beat that, but we are currently right here, and we're hovering right around that. Are we going to correct here or continue on is an unknown. We don't know exactly what we're going to do here, but this is where we currently stand. Now we're looking at a daily chart going back 6 months, S&P 500, so you can see the candlesticks a little bit more clearly in this chart. And I took and did a Fibonacci retracement, and I grabbed it from this low over to the recent high. And the retracement shows you the 38.2, 50, and 61.8% retracements. I'm trying to capture this 50% retracement when hoping that the market will correct approximately 5.5% from its all-time recent high. I mean from its recent high, and then close out that call position, and then hopefully this market will continue on. We got to see how the market does and how it reacts. Right now, we've bounced off of this and we're kind of moving sideways, but only for 2 days of trading. MACD has a negative divergence because you've made a higher high on the actual chart, a lower low on a lower high rather on the MACD here, so that's a negative divergence, but we'll see how this plays out. Now we are looking at a ratio chart of the equal weighted S&P 500 symbol RSP to the normally weighted S&P 500 symbol SPY. Now I have 3 charts here all in one. So the ratio chart is the red and black lines. The S&P 500 is the blue line. The equal weighted S&P 500 is the green line. And on the ratio chart, you can see that in the last, this going back 20 years, weekly chart, and in the last 20 years, the MACD has gotten this deep only 3 times, in 2009, in 2020, and now in 2023. The last 2 times that it happened, in 2009 and in 2020, when we crossed above when the MACD crossed above its signal line, then if you look at the blue S&P 500, we had great bull runs after that. This one didn't last as long as this run, but this one did last a good year and a half. And we have just crossed above the MACD, signaling to us that we are hopefully in this, it's just the beginning phases of a bull market run. The troubling and scary part about this chart is how when the ratio chart fell off a cliff here, here, and also here, the S&P 500 the last 2 times, which is the blue, also fell off a cliff here and fell off a cliff here. In 2023, the ratio chart fell off a cliff, but the S&P 500 did not. As a matter of fact, it advanced. So that can be scary, because if you're going to take on long positions now, and if indeed this correction is going to take place, like it has in the past 2 times in the past 20 years, then you're going to, if you're invested and you hold that whole time, you're going to absorb that loss. I would prefer not to hold that, but we got to take what's in front of us, and what's in front of us right now is a positive MACD crossover and slow stochastics rising. Ray, one of our listeners here, commented about how he really wants to see this MACD cross above the 0 line before he believes in it. And there's a lot of good truth to that, to holding out a little bit. And I'm holding out too to take on more longer positions, because I'm thinking that we're due for a pullback anyways. So hopefully we will pull back. It actually will be healthier for this market. Otherwise we could see something like this, which is a very good pullback in a short order of time. Here it completely fell off of a cliff, the S&P 500 in 2008, at the end of 2008. Just wow. So anyways, that was the mortgage meltdown over here. And then here was the COVID crisis over here. But here we are in 2023. So we are watching this closely. Now we are looking at the VIX volatility index, the fear index. The VIX is at rock bottom low. We were in this, which was still a low trading range. Then we dropped below that, and we have been in this low trading range since the beginning of June. So we've been in this for quite some time. The S&P 500 has had an incredible advancement during this entire process. The MACD is showing a positive divergence on the VIX, which means that if this continues, then the VIX is going to come up. You remember that the VIX works inversely to the S&P 500. If the VIX jumps up, the S&P 500 is going to jump down. So we want to be watching this. But right now, we are still remaining in this ultra low fear range, meaning that the market has extreme greed and it has no fear. That's a recipe for disaster for long-term buy and hold investors. Now we are looking at a chart of the TD Ameritrade's Thinkorswim platform, and I have up here you've got standard deviation. So you got the +2, -2 in gold, +1, -1 in pink, the midpoint and the dashed green line. S&P 500 is between the +1 and plus 2 standard deviations. Kind of hit a spot there about midway, and it looks like it's tapering and moving sideways. There's not a lot of space in this chart going back 1 year, except for way back here in August of 2022. So we're watching this to see what the market is going to do right now. Now, I did say in an earlier video that I was going to hold my long call until I tapped that 460 level where I have an alert. That alert never got sent to me because we never hit 460. Currently, the market's at 452.18, but I figured I had enough profit in the position. We're very close to the top here. This could be it before it starts to roll over, and I just wanted to bank that profit, so I took that profit. So that's where we currently stand. I have another alert ready to send to me at 426.06, which is this support level here. We'll see if we hit that. Now we're looking at the same chart, but instead of going back 1 year, it's only going back 3 months. And you can see everything right here. And on this chart, we're about the midway point on this chart. You can see my alerts right there to see if they get tagged. Okay, I have just given you a ton of information in this video. Now comes the critical thinking. What are you going to do with that information? That is one thing about all these other guys that just show you what the charts are doing, but they don't tell you how to trade or invest in that market. They just show you what they see the charts doing, but they don't show you how they put where they put their money. Okay, so 7/22/23, my market summation according to me, your host. My name is Ken. And now what I'm going to do is wait and watch, as I have my positions already in place. My expectation is for the market to correct about 5 to 10% over the next 3 months. I can't give a time frame because I don't know when, but normally speaking, markets correct on average 10 to 15% per year in normal, healthy bull markets. So I would expect that to happen. And now we've got the summer doldrums also coming up. So we definitely should absolutely correct down. We'll keep watching this market and see how we do. So we've got that in the money position. So what will happen is when the market does correct, like I explained earlier, I'll close my in the money covered call position, hold the SPY shares going long, and then possibly pick up some long call options and to make some more bait, some more profit. So we'll see how this market plays out. I currently have downside protection with that in the money covered call, and in the meantime, don't forget that I am selling a covered call. I'm selling that option, which gives me profit because I am selling time premium on that call. So I am making a small profit at the same time that I've got that downside protection. So all in all, not a bad place to be, especially if this market corrects. We'll profit handsomely when that happens. I mean, markets go up and markets come down. It's just what they do. So it's just natural. It just hasn't happened yet. All right, so I hope you've got some valuable information out of this video. If you have not done so already, go ahead and hit that subscribe button, ring that bell, and smash that like button down. I wish you good trading.